Hello there, this is the Bookkeeping Master on YouTube. Welcome to another video. This is part 5 of how to prepare year-end accounts, how to prepare the financial accounts for a company or business. This video will cover depreciation. Whippy! Yoo! Depreciation. It is amazing. It is fantastic. The first thing to really mention before we get started is depreciation. This will be the first of a series of adjustments that we'll be making to the year-end accounts. And these adjustments are made through a journal entry. So this video, really until the end of the course now, will be calculating figures to post to the accounts to adjust the accounts. And these adjustments are usually always posted to the accounts using a journal entry. And the first thing I wanted to mention about this is try and keep all these adjustments within a single journal. Because I've seen some accounts in the past where there are 10 journal entries, 10 separate journals, 1 for depreciation, 3 for accruals, 4 for prepayments, 1 for the tax charge for the year, and so on. And it can just look very messy. It will make your life easier and it will make things look a lot more professional and tidy if all the adjustments are within a single journal. And if you're using accounting software, which most of you will be, you can adjust for depreciation, save the journal, do another calculation, edit the journal, add the next adjustment. So you can go back and forth. It's not like you have to calculate everything first before you post the journal, because you can edit the journal and add things to it. But try and keep all the adjustments within a single journal, and you can name the journal year-end adjustments 2024 or 2025, 2026, whatever. It keeps things very tidy. Now when that journal's done, I suggest that you save it or print it off so you can keep it for your records. That also makes things look very professional and tidy. So that's the first thing I wanted to mention, is try and do a single journal rather than lots and lots of journals for all these adjustments. Try and keep everything on the same page. And going on from that, every adjustment you're going to do requires some sort of calculation. So keep really good records of those calculations. I just use like an Excel file. I have a single file that has my calculations for the depreciation, for the accruals, for the prepayments, for the tax charge. All that is together. That will make your life easier if you ever have to go back and look at figures. But if the business is ever inspected, if your work is ever inspected, whoever's inspecting will likely want to see your calculations. If you have everything laid out in a single file that you can bring up on a click of a button and it's all accurate and all looks very tidy, that's going to do you a lot of favors. If you have no records of the adjustments, of the calculations for those adjustments, then it might not go too well for you. So they're the two things I wanted to mention, and I won't mention them again. So let's jump into depreciation. This is not a depreciation course. I have a free course which is currently under construction. If you're watching this video at some point in the future, it's probably ready. You can go and watch that course. This video will not teach you how to do depreciation. This is a year-end accounts course. It's not a depreciation course. I'm assuming you already know how to do depreciation. If you don't, go and watch that free course. There's no registration. It's just like this one. And then you can come back and carry on with this video. Okay, a few things I did want to mention about depreciation. The first one is methods and rates. So there are two main methods for depreciating assets. That is straight line and reducing balance. And there can be all sorts of rates. Now the reason why I wanted to bring this up in this video is which method do you use and which rate do you use? It is all down to the expectations and requirements of the tax body within the jurisdiction that the company is trading in. So here in the UK, if a method has been used in the past and a certain rate has been used in the past, you have to stick with it. So if computer equipment has always been depreciated using straight line depreciation at 25% over 4 years, you have to stick with that moving forward. You can't chop and change depreciation methods and rates. So this is why I suggest you speak to a tax accountant. If you're unsure, then find this out. Learn the methods, the rates, learn what the expectations are in the country that the business is operating in. So methods and rates. There are two methods. There could be an infinite really amount of rates. If it's a new business, you can generally choose those methods and rates yourselves, but don't take that as gospel. Do not take that as advice. It depends on which country you're in, which country the business is operating in. And journals. I've already mentioned journals, but all the depreciation will be posted using a journal. Now, the other thing I wanted to mention is depreciation accounts. In order for the accounts to look professional and look right, you're going to need 5 asset accounts, or 5 depreciation accounts, I should say, not asset accounts, 5 depreciation accounts for each asset category. So the categories are generally computer equipment, fixtures and fittings, or furniture and fixtures, plant and machinery, and then motor vehicles. There might be other asset categories, and that's fine, but they're generally the asset categories that assets fall under that are depreciated. There are other assets such as property, but that's generally not depreciated. And there are other assets like stock, which obviously isn't depreciated. So the assets that are depreciated are generally computer equipment, plant and machinery, furniture and fixtures, or sometimes fixtures and fittings, and then motor vehicles. So each of those categories is going to require 5 separate nominal accounts for depreciation purposes. The first is assets at cost brought forward. So that's all of the asset purchases. So for example, all the computer equipment purchases since the start of trading. It's a record of every asset purchased, the date, what was purchased, and the amount from day one. The second is the same but for depreciation. So it's an accumulation of the depreciation every year or every month, every quarter. It depends on how often it's done, but the depreciation of those assets from day one. So these things keep track of the assets purchased and the depreciation from the beginning of trading. Now, asset additions is for assets purchased in the year or within the reporting period. So this is specific to the period that's being reported on. If you're doing year-end accounts, it will be for that financial year. Same with asset depreciations. The depreciation you calculate and post to the accounts, that will go under asset depreciation. And then we have depreciation expense, which goes to profit and loss. Now, what is the difference between these two ones here, these two bottom accounts? This one's for the balance sheet. This one's for the profit and loss statement. So once you've calculated the depreciation for the year, it will be debit depreciation expense to show as an expense on the profit and loss statement. And it'll be credit asset depreciation to bring down the value of assets on the balance sheet. So that's a very quick overview, a lot quicker than I would like it to be, on depreciation. If you need a refresher, if what I just said was gobbledygook, you did not understand it, you probably need to take my depreciation course, and I'll put a link below. If you're watching this video as it's being uploaded, soon after it's been uploaded to YouTube, and that course is not ready yet, but it will be. I'm working on it. Okay, once the depreciation has been calculated and you've kept those detailed records and you've posted it to the accounts, we're ready to move on to the next step, the next year-end adjustment, which will be covered in the next video, video 6.